The Frank G. Zarb School of Business and WRHU-FM Radio Hofstra University invite you inside the Z-Suite.
Hello, I'm Janet Lenihan, Dean of the Frank G. Zarb School of Business at Hofstra University. Welcome to Inside the Z-Suite, featuring current topics and talks with business leaders across every industry. Today, we're stepping inside the American housing finance market, which faces significant challenges, including elevated interest rates, which have more than doubled since 2022, and a shortage of affordable homes. And though housing inventory is creeping back up slowly, it still remains below historical averages. The U.S. Chamber of Commerce attributes the limited housing supply and high demand to the lingering effects of the 2008 Great Recession, a global financial crisis that led to a decade of underbuilding, leaving the market unable to accommodate the influx of millennials entering their prime-time home buying years. The result? High housing prices and limited accessibility. Joining us today to discuss current issues in housing finance and the path forward is Ed Watson, an industry executive with over 30 years of leadership experience in global financial services. He has held executive-level positions at organizations such as Citigroup and Fannie Mae, where he gained significant experience working with various regulatory bodies. Additionally, he has served as a consultant and as a limited partner and advisor at NISA Partners, a fintech-focused venture capital firm. Ed also proudly serves on the board of directors at Odyssey House, a nonprofit organization. He received his bachelor's degree in finance from St. John's University and an MBA from the Zarb School of Business at Hofstra, where he serves as a member of the board of trustees. At Zarb, Ed shares his experience as an adjunct professor of finance and a member of the Dean's Advisory Board. Ed, welcome inside the Z-Suite.
It's a pleasure to be here.
So we have so much to unpack today.
Yes, we do.
But before we get into all of that, why don't we start with your journey in the housing finance industry? How did you get involved? What attracted you to it?
I had taken a year off. I had been at Citigroup for 25 years, and I got permission from my wife to take a year off, just kind of unwind a little bit, and I'd learned how to scuba dive. And one day I got a call from a gentleman named Herb Allison. I thought it was one of my friends just pulling my leg. Herb was the former president of Merrill Lynch. He went on to become the CEO of TIA Craft, and I wasn't really keeping up with the news too much. He was pulled out of retirement by then Treasury Secretary Hank Paulson to be the new head of Fannie Mae upon it going into conservatorship. Herb turned around and just fired the whole management team. Someone had referred me to him to potentially run operations and technology as part of the new management team. So he convinced me to go to Washington to talk to him, and I did. And I did explain to him that, married, I got 6 kids, 4 in grade school. My wife's an MD at Citi, and we're kind of stretched to begin with. And I didn't know that Herb was a Navy SEAL. He said to me, "Son, are you a patriot?" I went, "Yes, sir." And that's how I got to Fannie Mae.
That's great. Great story. Well, before we get into the current debate around taking Freddie Mac and Fannie Mae out of conservatorship, let's take a step back.
Sure.
Because I don't think most people really understand the industry. And so can you walk us through, in broad strokes, the housing finance industry and how important is it to the overall economy of the U.S.?
It is tremendously important. Depending on which economist you read, it's 16, possibly as high as 20% of the U.S. GDP. It's everything from the supply chain through the building of the houses to the labor market, all the ancillary things that go along with that. I think another thing that people don't really understand is not just the importance of the housing market, it's also the importance of some of these housing finance corporations that we have. And I'll separate a little bit. Everybody heard of Fannie Mae and Freddie Mac. And I'm sure most people have heard of Ginnie Mae. Most people have heard of HUD. Most people have heard of FHA loans and VA loans. So let me just kind of put that into perspective. Ginnie Mae is explicitly guaranteed by the U.S. government to ensure VA loans, FHA loans, and through the securitization process. So banks do these types of loans. Ginnie Mae has a whole securitization process sold to investors. That brings liquidity back to the banks, which is extremely important. If there's a default, the government literally pays the investor, right? Fannie Mae and Freddie Mac are so-called GSEs, government-sponsored enterprises. Also, Federal Home Loan Bank is also, but has a slightly different model. where the GSEs are the stockholder-owned companies. Post-conservatorship, the U.S. Treasury owns nearly 80%. I think it's 79.9% of the GSEs. And Fannie Mae and Freddie Mac were both created by Congress. They have a congressional charter that says they're allowed to effectively buy mortgage loans from banks, repackage them, sell them as MBS, mortgage-backed securities, to investors, brings liquidity back to the banks, number one. Number two, they worked under what was an implied government guarantee because they're shareholder owned. And it was like a wink, wink, nod, nod. If something goes wrong, we're sure the government will step in. No one ever said explicitly they would until the housing crisis in '08 when Fannie Mae and Freddie Mac lost a ton of money, literally had negative equity. And there's so many different elements that led up to that in retrospect makes sense. One was the Fed kept interest rates really low in the early part of the 2000s, right? So that's one thing. Second thing was that incented people to refinance their homes into lower rate mortgages. Two, culturally, we changed a bit around that time. I remember my parents paying off their mortgage and having a party with the neighbors. People were now borrowing against their house to go to Disney World, whatever it was. Additionally, there was a lot of, I would argue, predator lending that was going on. Some mortgages a lot of people didn't understand, such as negative amortization loans, where you make a payment and the balance goes up. So there was a lot of that was going on. We're just flush with liquidity. So lots of liquidity in the market. People buy bigger houses, right? The second thing that's interesting about our housing market, and this is critically important and part of really kind of our system with the GSEs, and also with Ginnie Mae, is that we're the only country in the world that offers a 30-year fixed rate prepayable mortgage. We're it. Another important point there is the non-recourse loans, meaning that if I don't pay my mortgage, right, I could throw the keys to the bank and I could have 5 other homes. They can't touch them. They can't touch my 401k, my IRA, my investment account, whatever. They can't touch them. Every other country, that's all part of the security that's put up. And also, like I use Canada as an example, you can get a 25-year mortgage, but every 5 years the rate resets. That reduces the bank's interest rate risk. So now with Fannie Mae and Freddie Mac, we'll stick with those. Basically what they're doing is they're stripping out the credit risk for investors, and the investors are taking on 2 risks. One risk is the interest rate risk. Your second risk is the prepayment risk. So it makes it a great incentive for investors to put money in. The banks love it, so they get their liquidity. There's a whole daisy chain of events that go along there. Now, one of the big issues that we're going to face when we discuss what to do with the GSEs is the so-called guarantee fee, or G fee, as they call it in the industry. Embedded in the cost of a mortgage, or the rate that a mortgagee pays, is the servicing fee. The bank collects the money, then essentially sends it to Freddie and Fannie, who in turn takes their G fee out and sends the money on to investors. And that G fee right now is about 46 basis points of 0.46%. So that just becomes part of the mortgage cost. Now, if Fannie Mae and Freddie Mac, I think we're getting ahead of ourselves a little bit here, but if Fannie Mae and Freddie Mac were then released from conservatorship and said, you're fully private companies, and guess what? You do not have a guarantee, that G fee is going to go up. If you take a look at the size of Fannie Mae and Freddie Mac, roughly speaking, there are about $12 billion in mortgage loans outstanding right now. Fannie Mae and Freddie Mac are behind half of that.
So I'm going to stop you right there. You've just said so much, right? And I think this is fascinating and so helpful. A couple of terms you threw out there that I don't know that our average listener really understands. Negative amortization loan.
Yes.
What is that? Basically,
the loan has in it a below market interest rate. So therefore, if I make a payment today, I paid my quote-unquote principal and interest, but basically I just covered my interest payment. And it didn't even cover the interest payment, so therefore my principal goes up. So my mortgage balance could have been, I'm making numbers up, $100,000. I make a payment and the mortgage balance is $100,001.
Why would anyone do that type of
cash
mortgage?
Out, cheap. They're sold on the payment, not on the amortization or gaining equity in the house. Because right now you have a payment of $5,000 a month. We could refinance that and give you $50,000, and your payment's going down by half. Predatory.
Yeah.
Yeah. And no one went to jail for that, which makes me crazy.
Yeah. Yeah. So you also said we're the only country that has a 30-year prepay mortgage.
Yep.
Why is that a significant factor? And why are we the only country that has it?
I'll look at it from 2 perspectives. One perspective is going to be as the homeowner, right? By having a 30-year fixed rate loan, I have no exposure. This payment's going to be the same for the next 30 years. I'll give you an example of that. One of my daughters, her and her husband bought a house. He works for a large investment bank, and between getting the mortgage at the low of the mortgage market during COVID and his discount. They're paying 2.65% right now. That's a 30-year fixed rate
That's
mortgage.
incredible.
So right now, inflation is chewing down their principal. So don't pay $1 more than you have to for this and just stay here for 30 years.
Yeah.
So that's the importance of that. Now, from the bank standpoint, they can't manage 30-year interest rate risk. It's just impossible. They can't do it. So therefore, the packaging of it into a mortgage-backed security, the sale to an investor with Fannie Freddie stripping out the credit risk, these are mostly institutional investors that are buying these things. And you're getting a rate that's slightly higher than a treasury yield. Now you actually have effectively an explicit guarantee of the U.S. government. Like any portfolio manager in fixed income, oftentimes they want to extend duration. They want to make their portfolios last longer and lock in different interest rates. So that works very well. Now, as a practical matter, the average mortgage is paid off in 8 to 12 years. People refinance when rates come down. People sell their house and move. So it's very rare these days that actually mortgage goes out for 30 years. But hence, like Canada, it's easy to hedge 5-year interest rate risk. It's impossible to hedge 30-year interest rate.
Yeah.
Rate.
Is that a contributing factor to where we're sitting right now in terms of that people aren't selling because the interest rates are
Absolutely.
so low that they have in their current mortgages? And
Absolutely.
so why should I walk away from this house?
Absolutely. That is a huge part of it, and they can't afford to buy another house because rates have doubled. Again, use my daughter as an example. If they were to buy our house today, they'd probably be paying 6.5% on their mortgage, which is 2+X. Where they are today. And they frankly couldn't afford that. The other thing that came out of the housing crisis that I still think is lingering, and I think it's kind of interesting interaction with COVID. People with second and third homes that were buying these homes in this low interest rate environment, they pretty much just threw the keys to the banks and to the GSEs to take it. So that was a huge overhang there, which exacerbated the housing crisis by forcing prices down even further. But then during COVID, everybody bid them all up again with the low interest rate environment. So, but that's why there's a housing shortage also.
So let's stick with 2008. You were really very much a part of what was happening.
Yeah.
Take us through that time. Are there any similarities from 2008 to today that you see?
That is a great question. And I think the short answer is no, because interest rates are higher. 1, 2, mortgage rates are higher, but look at historical mortgage rates. I think my parents' mortgage rate, which started in 1959, was 5.5%. So they're not much higher than historically where they used to be. I think the inflection point that's coming up, and a lot has happened with the GSEs just in the last month. And there's always a push and a pull between mostly the Republican Party and the Democratic Party. Because one of the contributing factors to the housing crisis was HUD. During the Clinton administration, when Andrew Cuomo was running HUD, he wanted the GSEs to do more low-income type mortgages. So they moved away from an 20% down payment, given an 80% loan-to-value ratio. Debt-to-income requirements were dropped a little bit. And then what happened also that contributed, which I want to get back to, I'll jump back to today, but I think it's important to understand. The investment banks got into mortgage-backed securities in a very big way, so-called private market. And Lehman Brothers is a perfect example of this. They had a mantra that said originate or die. So they couldn't get enough mortgage originations from third parties to package up and sell. They started to buy mortgage originators. Because interest rates were so low from the investor standpoint, they're chasing yield, right? I need yield. So the investment banks accommodated that. Within a mortgage-backed security, they did a number of multiple tranches, a senior to a mezzanine to a junior to a so-called Z tranche, almost like a piece of equity. And when the cash flows came in, the senior tranche got paid first, then the mezz, then the junior, and the Z got whatever was left over. And basically those Z tranches weren't sellable. They sat on the balance sheets of the banks, and that coupled with some other highly leveraged securities the banks were into at the time, that's what caused the crisis to hit the banks so hard. So roll that forward to today. There's a bunch of moving pieces. One is with a Republican in the White House now, the FHFA, which is the regulator of the government-sponsored entities, a guy named William Pulte, was just confirmed on March 14th. And within the last few weeks, he fired the CEO at Freddie Mac. He replaced board members from both sides on both companies and put himself in as chairman of the board. Keep in mind what happened in 2008 when Paulson put these things into conservatorship was the FHFA was made the regulator, but they delegated authority to the boards of directors. Now, Pulte essentially is the board of directors, as is also as a member of the board on both companies is the general counsel of the FHFA. So that is looking like it's going to exert more control over the GSEs. A lot of murmurings about cutting expenses at the GSEs, and they're very profitable. I think between them, they made $17 billion last year.
How did the conservatorship work back when it happened?
Yeah.
And, the federal government gave both Fannie and Freddie a whole lot of money. What happened to that? Where do they sit
Great
today?
question.
You're saying they're profitable.
Highly.
Is that because those money was paid back? Was the money never paid back? How did that all work?
What happened was, get my numbers right, there was roughly $190 billion injected into the two entities. I could be wrong on that. I have to double check that. Within a number of years, when I was there until 2013. I was at 08 to 13 roughly, and we were profitable. When I left. However, the preferred dividend, because they had purchased preferred stock to get the ownership stake, was 100% earnings sweep. So whatever we made, Treasury swept, which quite frankly they loved because it helped pay down the deficit. But having said that, it got to the point where, we have to release these things one of these days. They need to build a capital base. So it turned to a 10% dividend. And between the two companies right now, I think they have roughly $190 billion capital base. But if you look at the amount of mortgages they guarantee, that's not nearly enough. So roll that forward to today, it really is a bit of a Gordian knot, right? How do you take these GSEs, get them out from conservatorship, which means the government just owns it almost 80%, and effectively manages them. And given the moves that we made over the last few weeks, they're going to manage them much more closely. I also think both entities need to gain back their muscle memory of being public companies and not government owned. And I think that's part of what's going on today because they're a duopoly. They just get 50% of the business, just opening the doors. But then how does the government take this thing, these things, unwind them, put them back into private ownership, publicly owned, but private ownership? And how do you maintain a 0.46% guarantee fee and be able to, in a crisis, be able to effectively pay the principal and interest? On these mortgages. So there's a lot of different thinking about it. Possibly the government has a limited guarantee, maybe a full explicit guarantee, because what the risk is you lose the 30-year fixed rate prepayable mortgage, and most Americans would not understand. If that went away, they would be
devastating for many, sure.
Exactly. Secondly, how do you maintain liquidity in the mortgage market, right? How do you originate these mortgages, and the banks only have X amount of liquidity and balance sheet capacity, right? And to keep up that liquidity flowing back to the banks to originate more mortgages. But then also, how do you keep the investors interested? It really is a tremendous Gordian knot, and I'm not quite sure how it's going to work. Now, there's been a lot of progress on risk reduction with Fannie Mae and Freddie Mac, and what they're essentially doing is doing what are called credit risk transfers. Maybe not you and I, but institutions can say, I'll take a bit of that exposure, but pay me this guarantee fee plus a bit. Essentially, it's a credit derivative that's being done. Pay me your premium, but I'll take the risk of that. So we'll see how that market continues to develop.
So I think we all can understand kind of why they went into conservatorship, what the rationale for that was. Can you explain what's the rationale for people being advocates of removing them from the conservatorship and letting them go private to some extent?
It's the pull and tug of different philosophies, where I think, most people, not getting political, just kind of stating facts here.
Absolutely.
And many in the Democratic Party, not all, would say, well, let's just let the government do everything and let the government continue to own these things and let the government continue to effectively, explicitly guarantee mortgages. Then the other side of things, you have on the Republican side, small government advocates, even like a Rand Paul, for example, a libertarian. He wants to get rid of the Fed. Forget about Fannie Mae and Freddie Mac. Let the capitalistic system determine what the outcome, would be. And I think the happy place is someplace in the middle, and how they get there is going to be absolutely fascinating. We'll see how it all unwinds. Now, I do think it's going to be one of the things, and I could roll this forward to today, when we got the Fannie Mae and Freddie Mac, got the Fannie Mae, they really, being a duopoly, and being the fact that it's had an open door and make so much money, the revenue expense ratio was absolutely out of control. Very few efficiencies. So we built in, we re-engineered a lot of operations and all that kind of bit. And I think I reduced operational costs by 40%, in 4.5, 5 years, whatever it was. You take a look at the revenue expense ratio today, it's kind of crept back to where it was before '08. I'm sure that's what Pulte's looking at. I'm going to whip these things into shape and let them get their, capitalistic, high ROI type muscles back. And also kind of put in the fact that the reason you exist is because of Congress and because you have this now explicit guarantee. So how do you help us solve, you, Fannie Mae, Freddie Mac, how do you help us solve this problem?
And so when you talk about a revenue to expense ratio, what do you mean by that?
Basically, for every dollar of revenue I have 40 cents in expense. So again, highly, highly profitable. But you can see that ratio kind of crept back up again.
So when you were there and you took over, one of your main focuses was
Cutting
to
expenses.
improve efficiencies.
Is improve efficiencies, put in place a risk management structure, which we really didn't have. We didn't have a chief information security officer in 2008, 2009. We had some of our networking in the basement of the headquarters that one day bathroom leaked and wiped it out. But anyway, so we built a state-of-the-art data center. Again, we put in a whole risk management practices and the like. We also were very attuned to advancing the best employees. Now, you take a look at some of the folks that we worked with then that were kind of on the beginning, middle part of their career, and some of them now are in very senior positions, outside of Fannie Mae and Freddie Mac, which I'm personally very proud of.
Absolutely. You should be, right? Growing talent.
Like our friend Pascal.
Is so incredibly important. Absolutely. So, and this is probably an unfair question, but I'm going to ask it anyway.
Ask it.
If I asked you to share with us, what's your prediction? Do you think that it will land somewhere in the middle of conservatorship and privatization? And what do you think it'll take to get to that somewhere in the middle?
There's another bit that complicates things, which I should have mentioned and I didn't. President Trump has been making noise about a sovereign wealth fund. Right now, we're in a deficit. The country's negative equity. I don't know how we do a sovereign wealth fund. But what he's talking about is moving the Treasury stake in Fannie Mae and Freddie Mac into the sovereign wealth fund. That's kind of the seed, of that fund. So that would keep the government very much involved from an ownership standpoint. Maybe different governance structure, but from an ownership standpoint. And then I really believe that they want much more private capital in the market. And how they attract that is going to be interesting because if you raise the G fee, mortgage rates go up. If you do an IPO of these companies, it would by far be the largest IPOs ever. Can they attract that much capital without the right business model? Because all the investors were wiped out. When the conservatorship came in, pretty much wiped out. Even though you have some investors like Bill Ackman, who runs a big hedge fund, he's very bullish on it. He's been buying some of the common shares out there. And they have been rallying a little bit since Pulte was appointed, thinking that we're going to make this thing go private again and we'll all make a lot of money. So we'll see how that works out. I don't see us moving to a Canadian model. I think it's too much of a drastic move. I do think that there should be a long-term plan around how to mitigate interest rate risk from the bank's perspective to incent the banks to hold on to some of the loans. And keep in mind also, Fannie Mae and Freddie Mac, they only do what are called conforming loans. I think they're roughly $680,000, except in high expensive areas like New York, for example, they could do up to like $1 million in a loan, which, again, getting back to the difference between the two parties, the Democrats have been pushing for higher limits to get Fannie and Freddie more involved, and the Republicans always push for lower limits to get them less involved.
That's interesting. From the kind of common homeowner going for a mortgage, they don't really even know that Fannie Mae or Freddie Mac are out there, right? And how that impacts them. Sometimes they might see that their mortgage gets sold. That might make the homeowner nervous. But really, otherwise, it is seamless to them.
I have a non-conforming loan over that crazy limit. I just know my loan was sold into a private MBS because most jumbo loans are high credit, high, low debt to income, high LTV, all that kind of good stuff. They're very, very safe investments. And like anybody else, my mortgage is 3.35%. I'm not paying that off.
And so an MBS is a mortgage-backed security.
Mortgage-backed security, yes.
And in 2008, a lot of those had subprime mortgages in it.
Correct.
And that's what led to...
Correct. It was both the private market and Fannie and Freddie, so-called Alt-A loans, which is a nice term for subprime. Because, again, they drastically lowered their underwriting standards. And if you take a look under the Biden administration, they also lowered their underwriting standards. Ed Pinto is actually the former chief credit officer at Fannie Mae, long since retired, and he's been writing about the GSEs for years. And he's more towards the Republican side of things, that they're essential, but they should be limited. Yeah, we have a lot of exposure as a country. with these things. And, we saw it in '08, the amount of money that was put into the GSEs, but also the amount of money that was put into the banks. And most of that was because of these private loans.
Yeah.
And these crazy tranches that they built with the high level of risk, built into it, and the fact they couldn't get rid of a lot of it.
So going back to the average homeowner, if somehow we end up in the middle
Yes.
with our GSEs, right?
Yes.
Meaning that they're not a conservatorship, they're not necessarily completely private, but nonetheless, private capital flows in a little bit more. Is there any concern that the average homeowner has to be thinking about, any ways for the average homeowner to protect themselves if needed? Or is it really something that isn't going to impact, I'm still going to go to my local bank, I'm still going to get my 30-year prepaid mortgage and go along?
Yeah, I think for the average homeowner, I think it's really around availability of the loan, and it's around the rate sensitivity and the terms of the loan. Again, it goes back to if these guarantee fees need to be raised, right, in order to make sure that there's enough capital in the event of having to pay the investors, that the homeowner is going to be impacted by that rate, and not going to understand it. No, they're just going to say rates are higher, but rates are going down. Understand why the mortgage rates are going up is because the cost of the insurance is going up. I personally think, my personal opinion, you have HUD, right, which given the VA loans, the FHA loans. An FHA loan, you only need 2% down. Now, through Ginnie Mae, they're 100% guaranteed by the government. That's explicit, and that's a great promoter of home ownership.
But they have like income caps and...
Yeah.
Right.
Bits like that, absolutely. Definitely geared towards the low-income potential home buyer. Fannie Mae and Freddie Mac, I would argue that the limits have gone way too high. And it's a classic definition of inflation. You have too much money chasing too few goods. And if I can get a conforming loan at Fannie or Freddie for, let's call it $650, right, outside of New York State, you could buy a really nice house, right? And hence, that's another thing that's driving up home prices. So now if you took the conforming loan, it's going to be a number of things, took the conforming loan limit and you decreased it, that will free up more capital for lower income people. It may even pull down housing prices a bit because the demand's going to slacken a little bit. And then on top of that, if you built in some sort of private-public arrangement where you continue to have Fannie and Freddie do these credit risk transfers, which transfers the credit risk to independent third party. So they take the first loss, Fannie Mae takes the second loss, so maybe some kind of loss share, and then ultimately the government has to back it up, or you're not going to get the investors that come in and buy the stuff. It's just a fact.
Yeah.
Or they want much higher rates.
Well, Ed, this has been so fascinating. We are at the point in our interview where I get to ask all of my guests here at Inside the Z-Suite just some fun questions, not related to our topic today, just fun questions that I'd like you to answer quickly off the top of your head.
Uh-oh.
Are you ready?
Yeah, I guess so.
If you could trade places with anyone
Ooh.
or anything, who or what would it be?
Ooh, that's a tough question because I feel so blessed. I'm very happy with my life, my wife, my kids, most of the time anyway. And that's a tough question. I think about it still being me, but having an alternative path. If I just gone in a different direction, if I realized when I was 17 or 18 what I was actually capable of doing besides playing football, maybe I would have gone down a slightly different route.
Ed, I think you did all right.
Exactly.
All right, next question.
Yeah.
What is your favorite household chore?
Oh, that's a good one. This is going to sound crazy. I love washing pots and pans.
I started my work life as washing the pots at a bakery, so I appreciate
Me
that.
too. The old main maiden in Jericho.
There you go, right? There's something very satisfying about that.
Exactly.
But what's your least favorite household chore?
Okay, this is going to sound incredibly contradictory. I hate making the bed, but I can't leave the bedroom without making the bed. Does that make any sense? I feel like I walk around this freaking bed 30 times to get it right.
Well, there's a lot of psychology right behind making your bed every day before you leave to start your day.
If you can't do the small things, you can't do the big things.
Great advice. All right, final question. And this really is especially for the students who are listening in the audience. What is the key to success?
I always put it there are three things, and this is one of the reasons I actually left banking. With no particular order, but number one, like the people you're working with, like and respect. That's essential. You can't go to work every day and say, I don't like these people. Two is learn something every day. Learn every day. And 3 is get things done every day. It may not be a whole list, but get things done. And to me, those 3 things, actually, there's like a 3.5. Jump out of bed every morning to go to work. And I did that for 30 years. And like the 31st year, I went, I only like the people I work with at this stage.
Such great advice. Ed, thank you so much for being with us today, for sharing your insights on current issues in housing finance. Clearly, if you are considering selling, renting, or buying a home, it's essential to consult with a knowledgeable financial professional to determine when the time is right and what is a good fit for you. Thanks also to our show's producer, Adrian Stoller, and WRHU audio engineer, John Mullen, for your support. Be sure to tune in each week on the radio and online to WRHU 88.7 FM, Hofstra University, for a new episode of Inside the Z-Suite, or catch up with our show wherever you enjoy your podcasts. For more information about this program and the Zarb School of Business, please visit hofstra.edu/business. Until next time, I'm Janet Lenihan from Inside the Z-Suite.